All right, welcome to The Explainer. Today we're going to break down one single idea, a mental shift, really, that separates the most successful investors from, well, pretty much everyone else. It all comes down to whether you see the wild swings of the market as a fee you have to pay or a fine you're being punished with. This quote comes from Jeff Immelt, the former CEO of General Electric. He said this right after his time leading the company got absolutely hammered by critics when the stock collapsed. From the outside, it just looked like a total disaster, but from his perspective, from the inside, he saw this constant storm of challenges. Bureaucracy, regulators, investors demanding short-term results, stuff that was completely invisible to the rest of us.
And that right there is the perfect metaphor for investing. When we look back at a 30-year chart of the stock market, it looks so simple, right? Just this nice, smooth climb to the top. But that clean line, it completely hides the brutal reality of what it took to get there. All the terrifying drops, the sleepless nights, and the gut-wrenching uncertainty.
So just like that crazy hard job at GE, successful investing has this invisible price tag. It's a hidden cost that most people only discover when they're right in the middle of paying it. And honestly, by then, it's often way too late.
Okay, so that leads us to the big question here. We all hear the advice, right? Buy stocks and hold them for the long run. Sounds easy enough. But what's the actual price you have to pay to earn those amazing long-run returns? And here's a hint. You can't measure it in dollars and cents.
The real price of admission to the market is this emotional gauntlet. It's that feeling in your gut when the market's dropping. It's wrestling with the fear when everyone around you is panicking. It's battling that nagging doubt that maybe, just maybe, you've made a terrible mistake. And it's fighting off the regret of not selling at the very top or buying at the absolute bottom. That is the real cost.
And because that price is so incredibly painful to pay, a lot of people, well, they try to get the reward without paying for it. They try to pull off what you could call the Grand Theft Auto mistake. Okay, so check this out. Since 1950, the Dow has returned about 11% a year on average. I mean, that's a phenomenal return. It looks like free money just sitting on the table waiting for you to grab it. I mean, who wouldn't want a piece of that? But, and this is a huge but, here's the catch. The price you had to pay for that 11% was, in a word, dreadful. It meant living with constant uncertainty and just accepting that the market spends a massive amount of time trading below its previous all-time high. The fee for that incredible reward is a near constant feeling of being down. So when you're staring this reality in the face, you've really only got three ways to play it. One, you can just pay the price. You grit your teeth and accept that volatility is part of the deal. Two, you can find a cheaper asset, like bonds or cash, but then you have to accept much lower returns. Or there's door number three. You attempt the heist. You try to steal those high stock market returns while magically dodging all the volatility. Now, this is the siren song of market timing, trying to sell right before a dip and then jump back in just in time for the rally. But here's the thing. The market's money gods, they just do not look kindly on people who want the reward without taking on the risk. Trying to pull off that heist usually means you end up paying double.
And look, we've got the receipts to back this up. A study looked at these things called tactical funds, run by professionals whose entire job is to time the market and avoid risk. And the results? Well, the heist was a total failure. Less than a quarter of them, less than 25%, actually managed to lose less money than a simple, boring 60-40 portfolio. In fact, most of them made less money and were even more volatile. Think about that. They paid a higher price for a worse result. And all of this leads us to the single most important mental shift you can possibly make as an investor, learning to see market volatility not as a fine, but as a fee.
The psychology here is actually really simple, but it's incredibly powerful. A fine is a punishment. It tells you did something wrong and you should probably stop doing it. But a fee is just the price of admission. It's what you willingly pay to get something you really value, like a ticket to a great concert.
So here it is, the crucial point. Market downturns feel like a fine. They feel like you're being punished for making a bad decision, which makes your brain scream at you to sell and stop the punishment. But successful investors know that volatility isn't a fine. It is the fee, the price you pay for the opportunity to earn those higher returns over the long haul. Think of it like this. You don't show up to Disneyland, see the $100 ticket price, and call the police thinking you're being robbed, right? Of course not. You know that fee is the cost of admission to have an amazing day. You pay it happily because the rides are worth it. Well, guess what? Market returns are the same. They demand a price. And once you truly accept that there's an admission fee, you start to realize something crazy. Some of the greatest investment rewards in history, they came with the absolute highest, most painful prices of admission.
Just take a look at Netflix. From 2002 to 2018, this stock returned an unbelievable 35,000%. That is life-changing, build-a-dynasty kind of money. It's the roller coaster everyone wishes they'd been on.
But what was the price of admission for that incredible ride? This. For 94% of those days, let that sink in, 94%, the stock was trading below its previous peak. To get that spectacular once-in-a-lifetime return, you had to spend almost the entire time feeling like you were losing money or that you'd made a huge mistake. That is an insanely high emotional fee.
And this wasn't a one-off thing, not at all. Look at Monster Beverage. It returned over 300,000%, but spent 95% of its time below its previous high. The biggest, most incredible returns demand the highest fees in the form of fear, doubt, and regret. It's just part of the deal. So what's the big takeaway from all this? It's simple, but it's definitely not easy. The secret to long-term success isn't about finding some magical way to avoid paying the price. It's about figuring out what the price is, the volatility, the fear, the uncertainty, and then making the conscious decision to pay it. And that just leaves us with one last thought. That volatility fee is just the cost of admission for the chance at greater returns. It's not a punishment for getting something wrong, it's the ticket for the ride. So the real question you have to ask yourself is this: now that you know the price of admission, are you actually willing to pay it?